also like to take the opportunity to introduce our real estate professionals. Rick Tollickson, President and CEO of Hubbell Realty Company, Bob Beatty, Jan Berg, Corey Birkenholtz, Tyler Brady, Steve Brower, Heath Bullock, Jesse Bunny, Max Colby, BJ Connolly, Tyler Dingle, Peter Eggers, Arnie Ingman, Stanley Ingman, Linda Gibbs, Riley Hogan, Michelle Hudson, Ryan Jensen, Colleen Johnson, Craig King, Maury Knudsen, Rick Krause, John Ledetsky, Todd Malang, Dick Powell, Tim Sharp, Jeff Spence, Bob Stewart, and Paul Weeks. One indication that the market's getting better is our roster has grown a little bit since last year. In addition, I'd like to thank our marketing specialists, Lauren Brown, Aaron Jandeber, and Cassandra Lucky for their assistance with this event and their role in creating the surveys and the information found in your packets. From my perspective, which is based on our firm's leading market position and from the results of the surveys, commercial real estate in Central Iowa has fundamentally improved from this time last year and has certainly risen from the market bottom in 2010. The sustainable signs of improvement stem from the fact that occupancy rates have increased in a majority of the sectors, and transaction activity, both completed and planned, have accelerated. I indicated last year that real estate lags the stock market. This week, the Dow reached its highest point in nearly 3 years. Central Iowa real estate lags the primary markets, and real estate is cyclical, consisting of 4 primary phases. And this is my favorite slide. I use this all the time. Growth, plateau, recession, and transition. I'm sticking with my prediction from last year that our market is in the latter stages of the transition cycle. In 2012, I expect to see further improvement in market conditions as we slowly, and I emphasize slowly, move into a growth cycle in the early teen years. The next growth cycle, however, will not look like the previous, as lessons learned from the last recession will not soon be forgotten. Today, optimism exists in Central Iowa and across the state, and it should. Greater Des Moines' reputation as a dynamic financial and agribusiness hub is being matched by the quality of life elements available in our region. Yes, uncertainty remains, and unfortunately, I suggest that we all get used to it. The following macro indicators, as they have in the past, will affect the arrival and duration of the next phase of our real estate cycle. Job growth, quality and type, as I mentioned last year, is extremely important in the commercial real estate markets. Unemployment's at 5.7% and trending in the right direction. Access to and cost of capital, financing is flowing and flowing to smart deals. State and federal policy and priorities, interesting debate going on in the Hill with regard to commercial real estate taxes. We also want to keep our eye on the future of tax credits, and of course we want to make sure we understand the fate of the traffic cameras. Commodity prices. You could do a case study on how the agribusiness has really impacted commercial real estate markets in the last year. Consumer confidence hit a 3-year high. Demographic shifts definitely impacting the housing market. Supply and demand ratios. Ample supply of office, neighborhood retail, and land. Technology and social media. Convenience and Facebook are going to drive the consumer. And as I'm speaking, I'm sure Tyler is tweeting to all of his followers right now. Economic growth and political gridlock. But let's not get into political gridlock. Let's take a deeper look into our particular market segments. Our first presenter today is Rick Krause. For the past 22 years, Rick has specialized in the multi-unit housing arena. He wanted me to mention that he's completed 2 Ironman triathlons in the last 2 years, of 14 hours or so, right? Hopefully a little longer than this presentation. Rick has a keen understanding of the complex trends and issues associated with owning and operating apartment properties. Since 2006, Rick has sold over 1,400 apartment units. He's a frequent speaker on the topic of multi-unit housing and regularly publishes the Central Iowa Income Property newsletter, which focuses on multi-unit housing market. Rick Krause.
Thank you, Kyle, and thank you all for coming this afternoon. Seems like this event starts earlier and earlier every year. I think that's because Kyle's getting older and he doesn't like to stay out late any longer. I'm going to talk to you about the good, the not so bad, and the not too ugly. There'll be no spin, just the facts. I saw a headline the other day that got a good laugh out of from the National Association of Realtors, the Kings of Spin. It read, Housing Affordability Index improved in the fourth quarter. That means your house is going down in value. That's not what you want to hear. So, due to the market, it seems like everybody wants to own multifamily property today. This is because when the economy goes bad, people still need a place to live. As long as the housing prices are going down or not appreciating in value, people will choose renting over owning. Until the job market improves more, multifamily will be the top of the food chain. It is the preferred property sector, preferred over office, retail, and industrial product. Here's the good news. On the national level, 2011 sales were very strong. Sales of significant apartment properties totaled $54 billion. This was an increase of 54% over 2010. Transactions involved over 3,500 properties, a 49% increase over 2010. Current volumes have returned to familiar range, similar to the levels we saw in 2004, just before the condo boom and pre-crisis 2008. Capitalization rates are below 6.5% on a national level. There is further evidence that the recovery is entering a new stage. The wide gap in pricing between core and value-added assets is starting to narrow. Borrowers are also bidding down yields in secondary markets. The only property type stronger than multifamily is agriculture. The debt markets are competitive and borrowers are benefiting from lower mortgage interest rates. The 10-year treasuries have hung around 6% or 2% for the past 6 months. Distressed apartment properties represent only 10% of sales during the fourth quarter of 2011. Fundamentals are positive and forecasted to stay strong. The development cycle is well underway. None of these hold true for the other sectors of the market. Low yields in the primary markets have finally pushed investors into secondary markets, causing the yield gap to narrow. Yields in tertiary markets have remained high and have hovered around 7.5% for the past since 2009, making them a prime target for yield-seeking buyers. The wide gap that developed between core and value pricing has started to narrow, although core properties still command a premium. All these are signs of an improving market. Because of these noted improvements in the market, I made the comment in last year's presentation that for the first time in 3 years, I was optimistic things would improve. Here's the not too bad news. In the local market, things have changed, but relative to transactions, the results have been the same. On the local level in 2011, we saw $27 million worth of apartment properties transact within Warren, Dallas, and Polk County. This was the lowest level we've seen in the 10 years since I've been tracking this number. This might explain why I'm the only one in the commercial real estate arena in Central Iowa that specifically focuses on multifamily property. Look at the good old days, back in 2006 when $145 million worth of property changed hands. We're a far cry from there. In fact, last year there was one transaction that represented 50% of the total sales volume. Only 566 apartment units changed hands. That's an average of 19 units per property transaction. The mean was 8 units per transaction. There were 5 transactions in the 3 counties that exceeded $1 million. Summerwood Apartments, 48 units sold for $1.12 million, or $23,000 per unit. This was a bank-owned property sold by Tim Sharp and Linda Gibbs. Maple Leaf Apartments, 4210, 4214, Hubbell Avenue in Des Moines, 54 units sold for $1,550,000 or $28,700 per unit. This was an arm's length transaction where I represented the buyer. 2100 Grand Apartments in West Des Moines, an apartment building with no name. It's very similar to a horse with no name. If you're under 40, you might not understand this reference. Tyler, do you have any clue? Diamond Brook Apartments, 6370 EP True Parkway, 24 units sold for $2.11 million, or just under $88,000 per unit. This was a troubled asset. Tim Sharp and Linda Gibbs represented the seller. Mansions at Jordan Creek, 355 88th Street, West Des Moines, 140 units sold for $14.1 million, or just under $101,000 per unit. This was a troubled asset where Tim and Linda represented the seller as well. These 5 transactions represented 20 of the $27 million in transactions. The other 22 transactions were sold for an average of $318,000. This market did a complete 180. We went from a market with no buyers to a market with no sellers. I believe this is due to the conservative nature of Midwestern property owners, the concern with what else they were going to do with their investment money, and the uncertainty related to commercial property taxes in the state of Iowa. Here's more good news for apartment property owners. The vacancy rate in the Des Moines market is currently at 5.3%. This was a reduction from 5.5% a year ago. This is the lowest vacancy rate we've seen since 2002. Vacancy was lowest in the Central Business District, where it's only 2.1%, down from 5.9%. This is due to the momentum that downtown has generated with young adults. They're choosing to live and to work downtown. It's becoming a trendy location where they can do commerce and hop to the bars without getting in a car. The highest vacancy rate is in Indianola at 9%, up from 2.3% a year ago. In the western suburbs, the vacancy rate is fairly flat. This year it's 5.1%, last year was 4.9%. Other significant improvements were on the east side of Des Moines, where the vacancy rate went from 7.4% a year ago down to 5.7%. Vacancy by unit type was lowest in 1-bedroom apartments at 4% and highest in 3-bedroom apartments at 7.1%. Rental rates increased across the board throughout the Des Moines area in all unit types. The increase ranged from 3.1% for 1-bedroom apartments to 5.3% for 3 bedrooms. Approximately 14% of apartment landlords offered concessions in 2011 or 2012. This was a decrease from 20% in 2011 and 40% in 2010. The Central Business District saw the largest rent increase from 9.1% for a 2-bedroom to 21.3% for an efficiency. The East Side also saw a healthy increase, anywhere from 3.7 to 10.9%. We actually thought that the vacancy rate might be even lower than the survey indicated. We've seen surveys where it has been measured at 3.5% in some cases. We were surprised that the average rent increase is actually as high as it is, and also that few concessions were being offered by landlords. As this economy continues to improve and more jobs are created, we're going to see even higher rental rates. The unemployment rate for young adults is pretty bleak. They're being considered the lost generation. I've heard some estimates that half of young adults aren't even being counted in the unemployment numbers because they have stopped seeking employment. In 2007, it was estimated that 5 million young adults lived at home with their parents. Today it's estimated at 15 million. On the development side, permits have been issued for 1,060 apartment units in the Des Moines area, 935 market rate units, and 125 tax credit units. Some of those developments include Villages at Jordan Creek, 180 units in West Des Moines, Providence Point West in Johnston, 166 units, Fieldstream Apartments, 126 units in Ankeny, Meadowlark Place in Grimes, a Hubbell development, 120 units, Adams Ridge in Johnston, 112 units, and the Fleming Building downtown being converted to 96 residential units. In this market, we're still seeing a number of condo developments being converted to apartments, as well as office buildings in downtown being converted as well. We've heard a lot about commercial property tax debate recently. I wanted to touch on how this might impact communities when it comes to apartment projects. The most aggressive proposal out there is Governor Terry Branstad's, who has proposed a 40% reduction in commercial property taxes phased in over the next 8 years. When it comes to apartments, the impact will not be as severe as some predict. The value of apartments is determined by the cash stream that they create. When you lower the property tax on apartments, the net income will improve significantly. In the city of Des Moines, property taxes typically represent 30 to 45% of the overall expenses. With a 40% reduction in property taxes, this will improve the valuations, raising the assessed values, which will result in more tax revenue. Keep in mind the 40% rollback will be phased in over an 8-year period. With solid appreciation over those 8 years, the impact of the rollback might be negligible. Here's the not so ugly. Most of you in this room don't own apartments, unfortunately. You own homes. You want to know when the value of your home is going to go up. Remember what NAR said about the housing market and that the Housing Affordability Index is improving. That's not what you want to hear. Last year, I showed this slide with this graph represented the total number of homes sales in Polk County on a monthly basis since 2006, which was the peak of the market. This slide only includes homes that are arm's length transactions, no short sales, no foreclosures. Look closely. The red bar graph represents each month in the year 2011. The yellow graph represents 2010. For the most part, sales activity each month when compared to the previous year have been down since 2006, except for when tax credits were about to expire. But we noticed a trend in June of 2011, sales of in Polk County were less than they were in June of in 2011 they were less than they were in 2010. But starting in July of 2011 and for every month after that through the end of the year, the number of units that sold in Polk County increased significantly. So this is a good sign. If I were an economist, I would call this a leading economic indicator. Do you know that economists are wrong more than 50% of the time? Lucky for you guys, I'm not. I would call this a positive trend, and hopefully, at least in Polk County, the housing market has finally turned the corner. My predictions for the coming year are that if commercial property tax reform gets resolved, transactions should increase in 2012. Currently, there are many more buyers than there are sellers. As it stands right now, federal income taxes will increase on January 1st, 2013. Capital gains tax will increase from 15% to 20%. There will be a new capital gains tax of 3.8% on income earners of over $200,000 individually and $250,000 as couples to support the health care legislation. All told, there could be as much as a 59% increase in capital gains tax on the federal level. This should spur property owners to sell their property this year rather than next year. I also think that occupancy will remain strong for several years to come. When the economy strengthens and more jobs are created, we will see some significant rent inflation as the housing market shows improvement, but at a slow rate. Thank you.
Rick, I must admit, I did start it early so I could get to the bar sooner. Jan Berg is an experienced real estate broker. Since 1991, she has brokered over 650 transactions, which is an average of 30 deals a year, many of which were in the office market. Jan was our firm's 2011 transactions leader and named the Iowa Commercial Real Estate Association Broker of the Year in 2009. Welcome, Jan Berg, providing this year's office market overview.
Thank you, Kyle. Welcome. My goal today is to further explain how the market survey's reflection on inventory and occupancy best describes the existing conditions and their effects on commercial real estate, as well as provide a picture of the proposed future challenges and expectations. Whereas the first half of 2011 was a bit like the movie Groundhog Day, where Bill Murray wakes up the same day over and over again. We found the fourth quarter of 2011 and the first quarter of 2012 demonstrated considerably more activity, although inconsistent and spotty. In fact, thus far, I liken 2012 to riding in a car where the driver chooses not to use the cruise control, and their inconsistency of the heavy acceleration and then letting up and then repeating this action over and over until the jerky motion is enough to actually create motion sickness. But I certainly do believe we have reached a tipping point and are headed in a new direction. A direction which just may appear more right for some than for others. Daily, I field the question, how's the office market doing? From a leasing perspective, it is definitely improving and looking up. And landlords ask, if you're seeing all this increased activity, then why do I still have all this vacancy? And why isn't the activity coming my way? Well, the activity is spotty, as I've said, and the belief that it's all about location, 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 at least in the office market, is no savings grace. The fact is, the inconsistency of vacancy, leasing activities, opportunities, incentives, and resetting of values is affecting tenants and landlords alike, a phenomenon not particular to Des Moines. Let's take a look at how Des Moines is stacking up, though. The overall office inventory, or what is referred to in the survey as the entire market inventory, consists of 28,500,000 square feet and 604 buildings. This is a makeup change of only 3 buildings since 2010, and an increase of just over 190,000 square feet. But more importantly, we need to focus on the 14,143,000 square feet, which is specifically designated in our market as competitive market inventory. That portion of the entire inventory that is considered to be competing for tenants. As of current, this market is comprised of 405 buildings as compared to 400 buildings in 2010. Further proof that new construction of competitive space has been nearly non-existent over the past 3 years. The competitive inventory makes up just under 1/2 of the entire inventory. Major increases in available square feet, specifically in the years of 2004, 2009, and 2010, are directly related to that movement out of competitive office space and into owner-occupied, non-competitive space. As a result of this major shift, initiated in 2004, we started separately tracking the 2 different types of inventories, the competitive and the non-competitively, to best demonstrate the resulting effects and the future impacts. Currently, we have over 2.8 million square feet of available competitive inventory, of which 1.5 million is available in the CBD, 1.2 million is located in the suburbs, and another 180,000 square feet of space is available that is sublease, and it's spread throughout all submarkets. Of the 14 million square feet of competitive office in the inventory in Greater Des Moines, 47% is considered Class A, and the remainder of the competitive market inventory is virtually distributed equally between Class B and Class C. A quick comparison of the Greater Des Moines entire market against the larger picture reports an occupancy of 88.5%, outperforming the national average by 5% consistently over the past 3 years. If we drill down to the occupancy for the Greater Des Moines competitive market, we find a fairly consistent occupancy rate hovering around 79%, a mere 1% increase over last year's numbers, and an attempt to gain ground loss since 2010. Looking at how each class of office space is performing, we find that competitive overall occupancy showed a 2.2% improvement in Class A, which was fueled by aggressive leasing incentives that prompted a move out of Class B and into Class A with minimal additional occupancy costs. Much of Class C's positive performance can be attributed to a number of small lease deals. To provide a reference point, the respective available square feet in each class is referenced to the right. If we look specifically at the CBD, we find a similar trend of Class A and C product outperforming Class B. The 8% spike in Class C occupancy can be attributed to a couple of events. The leasing of a 25,000 square foot building on Watson Powell Parkway that had been vacant for the last several years, and the result of converting office buildings to apartments and removing them from the square footage, or the square footage was removed from the office inventory. The same basic scenario of Class A and C product outperforming Class B space also held true in the western suburbs. Here, the majority of the increase in Class C can be directly attributed to a number of smaller lease deals. We also track current absorption. The definition of absorption is the net increase or decrease in actual area occupied between survey periods. Absorption can be difficult to comprehend as well as mathematically difficult to track, as buildings in the inventory are demolished or converted to other uses. Another factor that affects absorption is the changes that are caused by that shifting of occupancy out of competitive and into non-competitive owner-occupied space, and vice versa. But the headliner here, historical data confirms a new trend. The Greater Des Moines office market shows a reversal of a 3-year negative trend by absorbing 115,000 square feet since the 2011 market survey. Of course, the fact that we have had virtually no new competitive product come online impacts this positive absorption. Another notable change, quoted or asking rates have adjusted downward across all submarkets and in all classes, most likely in response to the prevailing inventory and economic conditions. In some Class A product, asking rents have been reduced by as much as $1 per square foot, effectively widening the range of rents for Class A product by lowering the bottom end of it. The ultimate effect had an erosion of tenancy out of Class B. This is something we haven't seen in the past decade. But looking at the current trends is where we find the basis for these numbers and the changes. The majority of the deals completed last year were under 2,500 square feet. And in fact, some 80% of those deals were 1,500 square feet or less. Business downsizing has stabilized, which can only provide improved confidence, which in turn creates more leasing activity. And leasing activity has definitely picked up, especially since the third quarter of 2011. We are seeing an increase in the number of startup companies, and potential business acquisitions and expansions are looming that will likely absorb some of the larger blocks of vacant space. Although this improvement is slow, it is improving, and it is proving to be steady. It only makes good reason that there has been no new competitive office construction. And we are not aware of any planned competitive office construction for 2012. There have been a couple of build-to-suits. These were modest projects of less than 15,000 square feet, one in Johnston and one in Ankeny, and they were built specifically to meet a particular business need and location. Financing remains at the top of the current challenges list. This affects tenant improvement dollars and negotiated rental rates. In fact, financing challenges have been the basis of many issues related to the office market. Another issue tied to the challenges of financing and refinancing is valuation and appraisals. Lending institutions look to appraisers to find comparables to support the value of properties. Ongoing inactivity and lack of transactions means appraisers are pressed to find comparable leases and sales to support or determine new value. The disconnect between what returns landlords wanted for their properties and what tenants felt they should be paying due to the current conditions of the market has narrowed. The continued lack of inactivity over the past couple of years has finally reached a tipping point. It is no longer a time to cut bait. It's now a time to fish. As of late 2011, landlords have developed a new appreciation for getting new tenants and recognizing and keeping an existing tenant, and that keeping that tenant is considerably less costly than losing them. I know I said this last year, but I can guarantee you that these current economic conditions have produced the ideal tenant market. A prolonged soft market paired with a limited number of tenants actively seeking real estate has spurred landlords to offer generous concessions and incentives. Reduced rental rates as much as 100% free rent or deferred rent, adding the term to the end of the lease in efforts to help make the landlord whole. 100% turnkey tenant improvements, free parking, moving expenses, and the opportunity to have the personal guarantee burn off prior to full amortization of the tenant improvements. It is now more about making smart decisions that create savings of money rather than the making of money. We are looking at opportunities to blend and extend on renewals, which is a proactive response to market conditions. Blend and extend is when a tenant with terms still left on their lease is able to negotiate a reduced rental rate and maybe even additional concessions if the tenant is willing to commit to a new, longer term. Tenants can use this as a way to improve their leasing term to match the current lease negotiation environment and save dollars. And landlords can use lease restructuring to their advantage by securing their relationship with existing tenants by offering unsolicited renegotiations of current lease terms and diminish their losses. Nobody knows when this market is going to turn around, but when it does, it is likely to catch us by surprise, and the demand is likely to outweigh the supply. Now, more than ever in the past 5 years, there is a need for lease negotiations to be based on anticipated needs. Larger blocks of space are currently being absorbed by tenants who exercise their first right of options on adjacent space, anticipating future pent-up growth and negotiating the opportunity to expand into contiguous space as activity and demand commands, effectively and efficiently manages real estate needs. Some options are even being negotiated on contiguous space currently under lease, just to assure future availability as growth occurs. The landlord benefits as new demand forces tenants to exercise their right and commit to the option space. Landlords have also become more willing to negotiate early termination clauses, which give tenants confidence to commit to new leases and expand their businesses. The aggressive negotiation opportunities for tenants do not come without consequences to landlords, but the new normal is lower net effective rental rates. Fundamentally, base rental rates are being eroded. Then, after subtracting the value of the negotiated concessions, the resulting net effective rental rate can be a reduction of as much as 25 to 35% below quoted full-service lease rates. Tenants have developed expectations of reduced rental rates and concessions as a part of the normal offering, and landlords are finding that these concessions are required to get the deals done. Tenants expect to extend their leases at current market or reduced rental rates. In order to improve market share, landlords have two options. They can look at the situation as a glass half empty or half full. For a period of time, it may require doing whatever it takes to win the deal. It may mean aggressive incentives and concessions, lower lease rates, and turnkey tenant improvements. This is a time to get creative in order to increase activity. Another option for landlords to increase market share is by way of purchasing existing office parks, particularly ones with higher occupancy and national credit companies who are on the front end of new anticipated growth and expansion. This allows for improved market share without the added risks and costs of new construction. From the perspective of the landlord, this sounds all too one-sided. However, be assured, you can expect to see noticeable improvements by year-end 2012. We will continue to see pockets of improvement at first, but we can expect continued improvement in all classes and all submarkets by year-end. New activity will provide lease and sales comparables, allowing appraisers to reset new market values. We believe we will see considerable more business transactions and business acquisitions and expansions. And banks have already shown signs of increased willingness to provide long-needed financing. All of this is a breath of fresh air to the Groundhog Days of 2011, opening up demand and building confidence, which translates into activity and more deals. Based on the study of economics, there is little doubt we are transitioning into the later stages of a soft cycle, where you see aggressive tenant negotiations, extensive incentives being offered, and lower asking quoted rates. We're also seeing labor losses bottoming out, vacancies peaking, which will continue to create more renewed confidence. It can be said, it was the best of times, it was the worst of times. Regardless, no one can repudiate that opportunity awaits. It is all about improving the bottom line, and that is smart business. For tenants, the most aggressive rents and opportunities to get more than you pay for are available today, making it possible to improve your bottom line. And in turn, landlords lease space and improve their bottom line. Thank you for giving me the opportunity to share this information. I hope that we will be able to help you make the most of your real estate needs in the coming year.
Thank you, Jan. Bob Stewart is recognized in the greater Des Moines community as one of the top commercial real estate professionals. With over 30 years of experience in the legal and real estate industry, Bob has assisted his clients with all facets of commercial real estate, including extensive involvement in the industrial market. In 2011, Bob was recognized by the Iowa Commercial Real Estate Association with the Transaction of the Year Award. Next, Bob will highlight the results of this year's survey and provide insight on the trends affecting the industrial market.
Thank you, Kyle. Good afternoon, everyone. It is my pleasure to give the industrial sector of the real estate market. While there's been some activity in the market in the past year, you'll see from my presentation that compared to pre-recession times that it's been fairly stagnant. That said, the metro area has done a great job over the last 5 years at improving the infrastructure that the larger users are dependent upon. Examples are the widening of I-35, 235, the Southwest Connector, the Southeast Connector. The logistical experts with these companies take a long look at the infrastructure as well as wage factors, available workforce, governmental incentives, and hats off to the greater Des Moines area for doing a good job of that. Let's take a quick overview of the national market. National lease rates have now fallen to 2006 levels. With a lack of significant development of industrial development nationwide over the last 2 years, CBRE is predicting an upward pressure on rents nationwide. Also, there will be increased nationwide demand for large warehouse facilities because low rents are encouraging companies to consolidate or upgrade into higher quality locations. National industrial vacancy increased in 34 of the 59 markets the CBRE monitors, and overall industrial occupancy was at 86.5%. We'll see in a moment where that compares to Des Moines. Let's take a look at the Des Moines industrial market. Our market, which for purposes of our survey compares warehouse, manufacturing, and flex space, consists of about 50 million square feet and over 1,000 buildings. As you can see, this is virtually unchanged over the past five years. In fact, last year I reported that the market had actually shrunk as several buildings had been demolished and there was no new construction. This year there was one new building that was constructed, which is the Hewlett-Packard facility on Army Post Road. I'll give some details on that in just a moment. Our survey measures, as you can see from the other sectors, inventory, absorption, and vacancy of all three categories. Let's take a look at the warehousing sector first. In 2004 and 2006, the Des Moines market experienced 1 million square foot increases each year. In 2010, the inventory actually shrunk by 300,000 square feet. However, 2011 showed modest growth of 440,000 square feet, This again primarily due to the construction of the HP facility. I was fortunate enough to be involved in this transaction. HP is using this building as a third-party fulfillment site. They consolidated their operations from Clarion and Urbandale. The fact that Des Moines was chosen for this facility is good news, and hats off to the city officials for the cooperation in making this happen, as well as the Opus Corporation. The building is state-of-the-art. It has a 40-foot clear height with bay sizes that accommodates 7 pallet high storage and narrow aisle racking. It has space to accommodate over 42,000 pallet positions. The 300,000 square foot building has 25 dock positions and can be expanded by an additional 100,000 square feet. Good addition to our industrial market. Let's look at absorption. Following the 2 record years in 2006 and 2007 of nearly 1.5 million square feet each, the next 3 years showed minimal absorption. In fact, 2 years ago was a record year in the wrong direction, as we had a negative absorption of over 800,000 square feet. Our survey for this year is much more encouraging, close to 700,000 feet of absorption. Again, major transactions were the HP facility and over 500,000 square feet of lease space in the Dixon Avenue corridor. Major tenants were agricultural related. With this positive absorption, occupancy has edged up 1% to 90.4%. You can see this compares favorably with a national average of 86.5%. Let's take a look at the manufacturing sector. The number of manufacturing buildings and spaces remained virtually unchanged over the last 3 years. While we saw a negative absorption in our 2010-2011 survey, we actually had a small increase of 100,000 this year. However, that's nowhere near the 2008-2009 levels of 350 and 250,000 respectively. As a result, overall occupancy of manufacturing space remains virtually unchanged at 95.5%. Our final category is flex space. This is defined as a combination of office and warehouse. This market is basically dead in the water. No new buildings have been constructed in the past 2 years. In addition, absorption has only been 17,000 square feet, and occupancy remains at 85%. Overall, rents have remained constant in the Des Moines area. Generally, lease rates on warehousing space range from $2.50 to $4.95 a square foot on a net basis, depending upon the age, quality of the building, and features such as clear height, loading capabilities, and interstate access. Lease rates for flex space are generally in the $7.50 for a finished space and $4.50 for a warehouse space. As I emphasize each year, despite the slowdown, we're fortunate to be doing business in Des Moines and the United States. I had the opportunity this year to travel to El Salvador to assist in efforts in bringing clean water, sustainable gardens, and erosion control to one of the shanty towns. A slowdown in the local industrial market takes on new perspectives such after a trip like this. In summary, with an improved jobs outlook nationwide and increased consumer confidence, we feel that 2012 will be a year of modest growth in the industrial market. While we don't see any new speculative development on the horizon, we're hopeful that one or another national companies choose to take a serious look expanding into the Des Moines market. Thank you for your time and attention.
Tyler Dingle is a vice president at CBRE Hubbell Commercial. He is recognized as a leading broker in the retail markets. His team has been involved in over 100 commercial real estate transactions valuing over $100 million in the last 3 years. Tyler has also found a niche in the triple net investment market, assisting Come and Go in their implementation of their sale-leaseback program. Tyler has been actively involved in the community, recently receiving the 2011 Big Brothers Big Sisters Volunteer of the Year Award. He was also recognized as the 2010 Young Professional of the Year. On the business front, Tyler earned the Iowa Commercial Real Estate Association Deal of the Year and was recognized as the Rising Star in 2008. His list of accomplishments makes him qualified to provide this year's retail market overview.
Thank you, Kyle. And thank you all for attending. You know, it's really great to see so many new landlords in attendance this year. Hopefully, as market conditions continue to improve, we can sell off some of the real estate on your books and get you guys back focused on banking. I couldn't think of a better way to start off my presentation than by offending half of our room here. Last year I started my presentation by stating that very little had changed in our market. I went on to show you some graphs and numbers to support this and ended by saying very little had changed. Today I'm glad to stand here and quote the late Sam Cooke, who said, "It's been a long time coming, but I know a change is going to come." What Sam didn't say is how quickly that change would come, and unfortunately that answer is slowly. Before I dig into the numbers in the survey, I want to take a moment to talk about the major factors that impact our retail space demand. Retail sales numbers continue their slow climb from the depths of the recession in 2009. There have been several missteps along the way as consumers remain leery about the strength of the recovery. You can see we are still short of the peak in 2008, but are moving in the right direction. Locally, we have fared even better as sales numbers increased 3.72% over the previous year to reach an all-time high. These increases in sales will help spur retail demand. Another key factor that many retailers follow is consumer confidence. That number is also moving in the right direction, and I read just this morning it was at its highest level since April of 2008. We are still short of what is considered the benchmark number at 100, which we haven't seen since 2007. On the right side of this slide is a graph depicting the perception of where the market is expected to be in 6 months, based on the current trend in consumer confidence in comparison with where things stand today. The consensus is that jobs will become easier to find and business conditions will continue to improve. One other factor that continues to play a large role in demand for space is technology, as Kyle mentioned earlier. The ability to shop online and have products delivered to your door the very next day has caused many retailers to downsize. Consider what Best Buy has done over the past several years. Another role technology has played is in electronics. I can't tell you the last time I've gone to the store to purchase a CD or a book. It's so much easier to download them to your iPad, your Kindle, or other electronic device. This has been the downfall for music shops, bookstores, and the movie rental business. For the purposes of our survey, we break the retail market into 3 separate categories. Regional shopping centers, which have historically included 4 regional malls. Big box retail, which consists of retail space of approximately 20,000 square feet and larger, including grocery stores, home improvement stores, and large retail discount centers. And lastly, neighborhood and community centers, which are made up of multi-tenant retail buildings with small and medium-sized tenants. Our regional malls have really been a bright spot as our market recovers. Jordan Creek Mall held their occupancy at 98% over the past 3 years and recently added the Nike factory store to their Villages area. Several retailers in the mall have continued their strong sales performance throughout the downturn. The Shields store was recognized as the #2 store in terms of sales value in that entire chain. In a retail presentation earlier this year, I caught some online attention for highlighting the sales of another retailer in this mall who apparently likes to keep these numbers secretive. This particular company consistently battles with the likes of the 80,000 square foot Yonkers building, or Yonkers space, and the 100,000 square foot Dillard space for the second highest gross sales numbers in the entire mall behind Shields. And they do it out of a mere 3,000 square feet of space. This tenant will, however, remain nameless. Valley West Mall has also had success in attracting new tenants. The recent additions of Chipotle, Famous Footwear, Taco John's, Kitchen Collections, and Noodles & Company have increased their occupancy numbers to 93%. Myrtle Hay Mall found success in making several improvements and bringing their retailers to the street to give them an exterior presence. With these changes, they were able to attract the likes of Ulta, Shoe Carnival, Panda Express, and recently announced Famous Labels and FL Home as new tenants. They are currently in negotiations with 2 large tenants they hope to have open later this year. This activity brought their overall occupancy up to 94.7% from 93.5% in 2011. While Southridge Mall has been removed from the survey temporarily, I would think it is important to highlight the changes they are making there to breathe new life into a center that severely needed it. Earlier this month, ownership released the first plan showing improvements scheduled to be made. They will start by demolishing nearly 243,000 square feet of existing space and opening back up less than 134,000 square feet of space in that same area. So it's about a little over 110,000 square feet that they'll be taking out of the Southridge Mall. This is a concept that has become well received by shoppers in other markets and is similar to the efforts made at Merlehan Mall. They've also looked outside of the traditional retail users to find tenants for the mall. Des Moines Area Community College is one that has been shown on their future plans with a 63,000 square foot facility. The second phase of this redevelopment includes a 94,000 square foot facility that will home the Iowa Soccer Association and the Iowa Barnstormers practice facility. This state indoor training center will provide the opportunity to host regional and national events and hopefully will bring new foot traffic to the mall. The big box sector remained very stable over the last year with a mere 0.4% decrease in overall occupancy to remain at a healthy 95%. The biggest gain in this market occurred in Northeast Des Moines, going from 93.7% to 95.2%, with the help of deals like Top Value Food, which found a new home at 801 University, along with Workforce Development and Employment Center, which will open this summer. Ankeny saw a small decrease in occupancy to 96.3%, with Staples vacating their location off of Hayes Drive and relocating to their new, smaller facility being built next to Menards and will open March of this year. The western suburbs took the brunt of negative impact with 70,000 square feet becoming available over the last year, which represents 1% of this entire market segment. With that said, this is the area that I expect to see the largest positive gain in 2012. Water Tower Place will see the addition of Whole Foods, who will backfill the space that Best Buy left behind, and Bye Bye Baby, a 20,000 square foot store that will backfill the former Borders location. The addition of a new Hy-Vee store at 86 and Douglas, coupled with other active deals in the market, will strengthen the health of the big box retail market. The next step, albeit a scary one, will be new construction. This will only occur if landowners can come to terms with land price expectations, which have decreased 30 to 40% from pre-recession levels. The last segment of our retail market is neighborhood and community centers. You could break this segment down one step further into the good, the bad, and the ugly. Now, I know that Rick used this same analogy earlier in his presentation, but I really feel like I've one-upped him here because I've got Clint Eastwood on a slide. Let's start with the good. New construction has picked up with 7 new or redevelopment projects in 2011. 3 of these projects are located in Ankeny, including over 21,000 square feet in Prairie Trail. Other projects include a buyer's realty center developed at the southeast corner of Merlehan Douglas, occupied by Chipotle, Aspen Dental, and AT&T. At the same intersection, Rich Eichner built a center that is approximately 80% occupied by US Cellular, Burger King, Mattress Firm, and Suntan City. The remaining space in this center is 3,000 square feet and carries an asking rate of $28 per square foot. The former Quality Ford building off of 8th Street in West Des Moines is one that went through redevelopment last year, adding a new exterior look to attract tenants including Iowa Health, Jimmy John's, and Smarty Pig. Come and Go convenience stores also built their new larger format store at this location, which includes an expanded food service offering. I look for 2012 to continue on this trend of new development. Jeff Spence and Paul Weeks are currently marketing a new project at the northwest corner of Martin Luther King and Ingersoll. They currently have 2 deals signed up, one on each end cap, and they're working through letters of intent on the inline space. Interestingly enough, they received 7 letters of intent within the first 2 weeks of sending this project out to the market. And they were getting rents of $20 to $25 a square foot, which is also impressive. This highlights the fact that well-placed projects are asking and achieving above market rents. Other new projects slated include the retail center at 5010 Millsip Parkway, asking $25 to $30 a square foot. A center being developed in front of the Super Walmart in Grimes, asking $18 a square foot. A planned center at Urbandale Marketplace, across from Super Target and Home Depot, asking $22 to $24 a square foot. And several planned retail projects along Mills Civic Parkway, west of the interstate. Overall occupancy in this market is up 2.3% over the past year, resulting in positive absorption of over 200,000 square feet of space. Some of the highlights are a 4% increase in the western suburbs, the first increase of any kind in this area in over 6 years. We also saw a 4% increase in South Des Moines, a 2% increase in Ankeny, and a 3% decrease in Northwest Des Moines. Many landlords may be asking, what does it take to attract new tenants and who's active? New deals are being driven by great locations and available tenant improvement dollars. Newer build-outs can exceed $40 per square foot, and tenants prefer to have their money invested in their core business and new store expansion rather than into their tenant improvements. Some of the retailers active in today's market include Qdoba, who we are representing in the market with plans to open a minimum of 1 store this year and 2 stores in 2013. Along with Chipotle and Pancheros, these 3 make up the burrito sector of our industry. Other quick service restaurants include Noodles & Company, Panda Express, and Jimmy John's. There are several wireless companies working to outposition each other in the market, including Verizon, AT&T, Sprint, and Spring Valley Wireless. Several single-tenant retailers have emerged, including Come & Go, who we are working with to open several stores in Greater Des Moines and up to 40 across the Midwest this year. Chick-fil-A, who will be building a new store along Mill Civic Parkway in front of Kohl's, Firestone Auto Care, and Ethan Allen, who we represented the purchase of their site along Mill Civic as well. If you are the type that needs your cup of joe to start the day, have no fear. You will soon have a Starbucks, a Dunkin' Donuts, or Caribou Coffee nearby, as all 3 of these groups are active. Dunkin' Donuts recently announced plans to open 20 stores in central Iowa over the next several years and are being represented by Bob Stewart for locations east of the Des Moines River. Other active groups include fitness and supplement stores, Whole Foods and My Buy Baby, who were mentioned earlier, and even Dick's Sporting Goods, who is taking a look at our market as they previously avoided us. Now on to the bad. While A locations have seen increased demands and higher rents, this slide depicts what we see more often at B locations. It has become a game of 2 strikes and you're out. And the first strike is that you have a B location. From there, tenants want free rent, tenant improvement money, shorter lease terms, no personal guarantees, and of course it always helps to pay that full commission to the outside broker. This has forced landlords to sign what they term below market deals in order to fill space. What we need to realize at some point, below market deals should simply be referred to as the market. The good news is there are several signs of life in our retail market, and the regional and local tenants will soon begin to follow the steps of our national groups. I expect rents to stabilize in the B markets with potential for rent growth in the second half of 2012. And finally, the ugly. I really just needed to include this slide to tie in the other 2 parts of the market. However, if you have this type of product in your portfolio, I apologize for the harsh label, and I wish you the best in getting it sold or leased. In summary, I want to leave you with a few takeaways from the presentation. The market is improving, and I expect it will continue to improve in the coming year. There is a strong demand for Class A buildings in great locations, and retailers are willing to pay a higher rate. This demand will drive new construction in neighborhood centers. There are many positive indicators in our market which are drawing the attention of some impressive national retailers. And I've often heard the expression that retailers are like sheep. They like to stay together. The more new stores we can bring to our market, the better chance we have to attract others. We have done a good job of surviving the downturn, and I truly look forward to what the future holds for our retail market. Thank you.
Thank you, Tyler. Having successfully worked together since 1990, Linda Gibbs and Tim Sharp have assisted their many clients in accomplishing their individual commercial real estate goals and objectives, while creating and maintaining long-term relationships. Tim and Linda have a combined 54 years of commercial real estate private capital group, focusing on the individual investor. Completing 2/3 of $1 billion in transactions in the last 8 years makes them our top producers in 2011 and puts them on the front line of the investment property and capital markets. Next, they will share their perspective of the issues and trends affecting investment properties.
familiar faces. You guys who do anything to skip out of work early. You know, I feel like we've just given this presentation, but it's really been a year since we gave our last presentation. It just goes to show you how time flies. I mean, I can remember when we were watching Johnny Cash, Bob Hope on TV, saw the creative genius of Steve Jobs. And here we are at the beginning of 2012. What do we have? No jobs, no cash, no hope.
We believe we can begin on a little brighter note than we did last year, despite the fact that 2011, whether you look back on it fondly or not, was a year full of economic and financial shock that reverberated throughout the global economy. One of our biggest concerns was the effect of rising interest rates on the commercial real estate market, and as we all know, that was a moot point. In general, the commercial real estate markets continued their rebounding trend in 2011, with commercial real estate values beginning to recover slightly in most markets and property sectors. And we saw a significant increase in investment sales. Here's what we witnessed nationally.
Investment sales were up 57% over 2011, according to Real Capital Analytics. However, the markets nationally started losing momentum mid-year, and overall volume for the fourth quarter was flat from a year ago. Interestingly enough, the transactional volume was up 57% as well. National averages for both unit prices and cap rates improved within all property types in 2011. However, the degree of improvement varied greatly. Well-leased Class A suburban offices and grocery-anchored shopping centers had the most cap rate compression. We continue to see high unemployment and constraints in lending.
Individual property sales were up 51% from 2010 and heavily weighted in the retail and apartment sectors, while portfolio sales were up 69%. We saw huge demand and focus on top-performing properties in core markets. Sales of distressed properties accounted for 15% of all the volume in 2011, which was slightly lower than a year ago. However, at year-end, over 51% of distress in this cycle has been resolved. Stress continues to grow for the CMBS loans, and the special servicers have made less progress in working out their troubles compared to other lender groups. Recovery rates on defaulted CMBS mortgages are also the lowest amongst the lenders. Since the crash, the CMBS market has proven itself willing to turn off the spigot with little notice. They stopped completely in the third quarter of this year, or 2011, and resumed again in the middle of December. Buyers have started to really broaden their horizons both geographically and by property type. Let's take a look at investment sales on a national basis.
Multifamily market, total sales of garden apartments were up 70% over 2010. Cap rates on Class A garden apartments have returned to peak levels in the top 40 metros, driven by institutional and REIT money. Sales of distressed apartment properties have declined significantly. Average apartment prices per unit are within 10% of the peak.
Cap rates for industrial properties fell by 60 basis points over last year, and compared to other property types remain high. Outstanding distress for industrial properties grew by 3% from 2010, and there is concern with recent reports that troubled industrial mortgages have outpaced workouts in the last 2 quarters. Investor interest in this sector has been tepid, with continuing disinterest in flex buildings by investors.
The office market, the CBD office properties were up 57% compared to suburban office, which was up 18%. Despite a shift in sales activity to secondary markets, average prices on a per square foot basis have been remarkably stable over the last 12 months. For most markets, CBD cap rates are approximately 50 to 75 basis points higher than the peak, except the tertiary markets where the average is 175 basis points above the peak. Investors are now favoring new Class A suburban properties located in major metro areas, with competition driving the cap rates to an average of 6.75% in these markets, creating a huge gap relative to other markets.
The retail property sales were a surprise, with a 91% increase over 2010, which was the largest gain among the main property types. This was due in part to a flurry of transactions involving major regional malls. Outstanding distress for retail properties grew by 6% over 2010. Anchored shopping centers are the darlings for institutions and equity funds, with cap rates dropping even further for grocery-anchored centers. And lastly, the age of the property is having a greater influence on pricing for single-tenant retail properties, with a 50 basis point spread between the newer and older properties, when in the past it's only been 10 basis points.
The rebound in investment markets was evident across all property types, as you will see later in our presentation. Several interesting things to note nationally. Only 2 of the top 40 most active markets experienced a decline in sales volume in 2011. Those were Orange County, LA, and Broward County, Florida. Manhattan recorded more than twice the investment volume of the next most active market, which was LA. They had a staggering 86% increase in volume year over year, according to Real Analytics. And in 2011, the 1031 market continued to be almost non-existent. We saw foreign capital invested in the United States increase significantly. In their mindset, the U.S. is on sale. Just ask the Chinese and the Canadians. Our challenging times have created great opportunities in the commercial sector, which others are recognizing as well.
We started showing distressed sales several years ago due to the significant volume. Here's a quick summary to give you a sense of the market dynamics that we saw. Since the start of the recession cycle, over $348 billion of significant commercial properties have become troubled, and at year-end, approximately 51% of those have been worked out. Although there was a decline in newly distressed properties in the fourth quarter, the lowest in 2 years, the volume is still very sizable. The significant point with the distressed loans on office properties is that 54% of the distressed volume has been worked out. Retail has seen the largest resolution at over 55% in 2011, or $15.8 billion. Industrial, which continues to have the least amount of distress, was up slightly at 38% versus 30% in 2010. Multifamily, which continues to be the second largest in total value, was 54% resolved in 2011 versus 37% in 2010. For the full year, $57.2 billion of new distress was reported, down from $92.6 billion in 2010, and a 60% decrease from 2009. However, let's not get overly optimistic here. The real challenge still lies ahead of us beginning in 2015, 16, and 17, when the majority of the CMBS loans will be maturing.
Distressed assets by market. This includes properties and portfolios of $2.5 million or greater. You can see that the Mid-Atlantic region had the least number of distressed assets at 588, with a volume of $10.8 billion. And the West topped all regions at 3,321 distressed assets with a volume of $45.1 billion. The largest volume, which would come as no surprise, were Los Angeles and Las Vegas. Let's look at the investment real estate sales volume, comparing national versus local statistics. Transactions nationally for real estate valued at over $1 million total $221 billion versus $134 billion in 2010, which was a whopping 64% increase over last year, but still less than one half of the volume at the peak of 2007, which is not shown on the chart here. But locally, we looked at real estate transactions over 500,000. The local sales volume was 174 million, an increase over 2010, which was about 40%. To put things in perspective, the sales volume nationally is still down 48% from the peak, and locally, we're still down 53%.
This chart reflects 2009 to 2011 cap rate comparison. Nationally, for Class A properties, cap rates declined in all property types. The most significant change was in suburban office, which decreased 230 basis points over 2010. Retail was down 70 basis points to 7%. Industrial was also down 70 basis points to 7.5% cap rate. Also note the multifamily cap rates at 5.7% nationally. We can tell you that the competition for Class A properties in the major markets, particularly in New York City and on the West Coast, have driven cap rates down considerably. In the Midwest tertiary markets, we did not see the same decrease in cap rates across the board. In the Midwest, the cap rates did drop in 2011 suburban office with a decrease of 100 basis points from 9.1 to 8.1%. Retail cap rates jumped 50 basis points to 8.5%. Industrial decreased slightly from 8.8 to 8.5, and multifamily decreased from 8.7 to 7.5% for a decrease of 120 basis points. As we mentioned last year, you must keep in mind that the recession hit our market last, as will the recovery. The state of the national scene tells us clearly that, albeit slow, we are in a recovery mode, and hopefully we'll continue to see more positive signs in the Midwest.
The 2009 to 2011 per square foot comparison nationally, in 2011, the per square foot for all office, including suburban and CBD, decreased from $230 a square foot to $210, or about 10%. This is the first year stats have been available for medical office or for the national markets, and as you will see, it's very comparable to our market. There's been virtually no change in the retail price per square foot. Industrial moved up slightly from $51 to $55 a square foot, and multifamily actually decreased from $106,000 per unit to $101,000 per unit for Class A properties.
Locally, office increased significantly from $40 a square foot to $112 a square foot, or 180%, due primarily to the decrease in sale of large distressed office buildings. On the medical side, we saw an increase from $182 a square foot to $205, which is basically the same as the national. Retail increased from $73 to $107 a square foot, which is a positive sign. However, this increase was due in part to a portfolio sale in our market that we'll talk about later. Again, we pulled the single-tenant sale leasebacks out as they skew the price per square foot. And the single-tenant sales dropped from $330 a square foot to $132 a square foot, a result of very few transactions, and they were much smaller in volume than in 2010. Industrial increased slightly by 13%, and multifamily increased significantly by 40% from 2010.
In reviewing the 2011 local sales transactions, we included Polk, Warren, and Dallas counties' sales over $500,000. The total office volume for 2011 was $25 million, which is a 36% increase over 2010, with an average sales price of $1,787,000 and an increase in transactions from 10 to 14. Medical office dropped by 64% to $6,225,000, with one less transaction, and average sales price dropped to $2,075,000. Multifamily sales volume showed significant increase in volume, going from $28.4 million to $42.3 million, or a 49% increase, with the number of transactions increasing by only 3. However, the average sales price increased by 33% to $2,650,000. Retail sales volume was up significantly from $24.7 million to $72.1 million. However, 52% of that volume was due to the sale leaseback of 5 local locations. And yet, the number of transactions increased from 13 to 22. Average sales price of $1.9 million in 2010 jumped to $3.5 million in 2011. But again, if we remove the 5 locations, the average sales price was only $94,000 more in 2011. Industrial sales volume decreased to $28.3 million with 5 fewer transactions, and the average sales price changing only by $14,500. Total sales volume increased by almost 40%.
Now let's look at some of the more significant transactions that took place in the greater Des Moines marketplace. The largest multifamily transaction was Mansions at Jordan Creek, 140 units, which Rick mentioned, sold for $14.1 million, 7.6 cap rate. We sold this to an out-of-state investor. Village at Maple Bend in West Des Moines, 14 units. This was a distress sale, 11.3% cap rate. We sold this to a private investor. Diamond Brook Apartments, 24 units in West Des Moines, sold for almost $90,000 a unit, 8.12% cap rate. We sold this to an out-of-state investor. Summerwood Apartments, another distress sale, sold at a 9.8% cap rate. We sold this to a local private investor. And lastly, City Heights Apartments sold for $940,000, $26,000 a unit for an 11 cap rate. This was also a distress sale. We sold this to a local investor.
On the office side, the largest transaction was the partnership building, which includes a 750 parking stall garage. We sold this for $4.7 million. At auction, it was a distress sale. We sold it to a Canadian investor. It was all cash. 5930 Grand Avenue, West Des Moines, sold for about $4.4 million or $154 a square foot, and that was to an owner-user. Iowa Health Systems facility in Ankeny, it's about 14,000 square feet, $4.1 million, sold for $294 a square foot, which represented a 7.64 cap rate. We sold this to an out-of-state investor.
The largest retail transaction, as we mentioned earlier, was the Dallas locations, $37.9 million at $133 a square foot. An out-of-state investor purchased these. Bridgewood Plaza in West Des Moines sold for $4.7 million, $88 a square foot. We sold this to an out-of-state investor at a 10.5% cap. And I can tell you this is quite a drop from when we sold it in 2006 for $11.9 million. Copper Creek Plaza in Pleasant Hill, $2.3 million, sold for $80 a square foot to an out-of-state investor.
Okay, the largest industrial transaction was the Moines building in Irvingdale, 345,000 square feet, sold for $36 a square foot. It was a short-term sale leaseback to an out-of-state investor. 10827 Prairie Drive in Irvingdale, sold for $20 a square foot. This was a distress sale to an owner-user. 5727 Northeast 16th Street, sold for $30,000. There's a 30,000 square foot facility, sold for $27 a square foot to an owner-user. 2120 Rittenhouse, sold for $36 a square foot. It was a distress sale. We sold this one to an out-of-state investor.
As in 2011, uncertainty remains pervasive with policy gridlock, the upcoming elections, and the volatility of the Eurozone markets. It's been stated that unemployment has dropped in the last 2 months, in theory. However, the reality is that the drop doesn't truly reflect the entire situation. Employment will continue to muddle through 2012, which will be the third consecutive year that employment fails to generate the amount of growth needed. That we begin the year with a level of unemployment we have makes it more painful, and that the upcoming year will again make little progress in growth of the economy. Capital is flowing, but only to the right opportunities. The current high level of uncertainty puts any projection at risk, but we expect the pattern of economic recovery to remain the same, with pockets of commercial real estate growth in select markets and regions as we continue through 2012. Shortages of large warehouse space will accelerate. Many of the industrial sector demand drivers are recovering nicely. This sector has reported healthy demand every quarter for the past year. As the economy continues to recover, 2012 will see more of these spot shortages as rents are still too low to justify substantial new construction. But with these conditions brewing, this will bring change on vacancy as the vacancies decline.
Experts say that retail rents have finally seen the bottom. They have consistently declined each quarter since 2008. This has and will continue to put downward pressure on retail investment sales in most parts of the country. With the exception of anchored centers and credit single-tenant properties, we expect retail investments to remain anemic. Debt market distress moves past the peak, but still remains high. Debt availability continues to improve while underwriting parameters appear to have stabilized, with life companies and some banks ramping up their lending programs. Currently, there are $83 billion in loans with special servicers. There's $60 billion in delinquency, with 12,000 loans totaling $140 billion on the watch list. This includes $20 billion in multifamily. Distressed loan resolutions and loan sales have risen throughout 2011, exerting a downward pressure on distressed property prices that will likely continue in 2012 in some areas. Couple that with the fact that there's another $360 billion in debt maturing, which could have a significant increase in the market depending on the lender's willingness to work with the borrowers. 2012 will mark an uptick in maturities of existing debt, creating a big demand for refinance.
Which should be a big opportunity for mezzanine lenders. Although more expensive, it will provide an avenue to create any bridge between the debt and equity piece in the capital stack. However, keep in mind that prices and loan terms have not improved enough for refinancing to be feasible in many cases, which should drive significant transaction activity. Notice I said should drive. The CMBS sector will be critical to improving liquidity in 2012. However, there are concerns about the market's long-term viability. It's feared that the CMBS markets are not likely to outperform the $31 billion it originated in 2011. Lending conditions will continue to be constrained in the secondary and tertiary markets as local and regional banks continue to work through their distressed commercial real estate portfolios. Regulators will not significantly relax pressure on the banks and real estate lending operations. However, low interest rates make borrowing costs more reasonable. The lending climate is strange today. It all depends on what banks or institutions you are working with. It's not a level playing field. Financing is not available for everyone. It's a fragmented market, which could be a result of where the money is coming from.
Underwriting will remain high, with Class B and C properties paying higher rates than Class A. The bottom line is the riskier the project or the borrower, the more expensive financing will be. Life insurance companies historically, the most diligent commercial real estate lenders, had a record year in 2011 and expect to place $45 to $50 billion in debt in 2012. Cap rate compression will continue, although very modestly. There is even a risk of modest increase in cap rates in certain markets and sectors. Given the current uncertainty of the Eurozone and the low pace of economic recovery, the Fed is likely to continue its threat of maintaining a low interest rate policy moving forward. This environment will prevent cap rates from rising significantly, even in spite of the uncertainty around the capital markets.
Multifamily continues to be the favored and dominant asset type across the country, and we will see little change in this for 2012, partly due to the availability of capital for financing the good, solid existing projects. We expect to see a continued increase in the flow of foreign capital in the U.S. The Canadians were the largest group of international investors flocking to the U.S. last year, followed by Latin America and the Asian investors. For Canadians, the U.S. is an ideal haven with their own limited investment opportunities in their country and the stable Canadian dollar. According to ADFOR, 60% of foreign investors plan to increase U.S. real estate investments in 2012.
Adford? Sounds like a social disease to me. Midwest market is recovering and the real estate community is fairly optimistic it will continue. However, it won't be quick recovery. It will be slow and steady after 2008 and 2009. That's not a bad thing. Many significant questions remain. How long will the low interest rates last? Will austerity measures and government budget cutting slow the economy? How will the European sovereign debt crisis affect capital markets? Will commercial real estate fundamentals improve? And there's the ever-present issue of Fannie Mae and Freddie Mac. Reform of those institutions could significantly alter the financing picture for multifamily properties.
The broad economy continues to recover very slowly, and hence everyone seems to be cautiously optimistic. Hopefully we will see a continued gradual improvement in market fundamentals. More and more investors realize the strong returns that commercial real estate delivers compared to other investments. According to NACREIF, private equity real estate has produced an average annual return of 8% over the past 10 years versus 6% for bonds and 3% for the S&P 500 index. And I can tell you that last year, the average return for private equity real estate was a staggering 14.1%. Tell me where else you can get that kind of return today. The foreign capital market certainly realizes this, as we mentioned earlier. With the upcoming fall elections, we expect continued consumer and business lack of confidence, a volatile market leaving investors tentative at best. It seems the only certainty is uncertainty, which will continue through 2012. Having said that, commercial real estate still offers investors a great refuge amid economic uncertainty.
Sam Zell was quoted as saying, "Come clean" in 2013. When asked what he meant, he said, "It's strictly that we have a lot of stuff in the system that is mispriced and not realistically held. And that's the result of pretend and extend and a bunch of other things." In order for commercial real estate to grow again, we need to eliminate the icebergs in the system. That cartoon has nothing to do with my talking. The bar is open.
Thanks everyone for attending today. We appreciate your relationship in doing business with CBRE Hubbell Commercial. Please join us in the atrium for a refreshment. Thanks everyone.